What's the best commercial property for a first-time investor? I get this question very often, and here is my honest answer. There is not one. Not a single asset class that is universal for everyone. What does exist is a property type that is right for you, based on your budget, your risk tolerance, and how much you want to spend managing something, and how forgiving the deal needs to be if one of your assumptions turn out to be wrong. And that last part, that's the part most people skip. Today, we're going to fix that. Hi, I'm Helen, a commercial real estate advisor based in Texas, Austin, Texas, and I work with investors, business owners, and entrepreneurs across warehouse, land, and multifamily properties. I have had conversations with first-time investors who came in thinking they knew exactly what they want to buy and walk away with a completely different answer once they actually work through their situation. That's what this video is designed to do for you. Before we compare property types, let's get clear on what a first-time commercial investor actually needs. It's not just the returns and it's not just the cash flow. The real goal for a first-time deal is this. You want something you can understand completely, something you can finance without heroics, and something that doesn't collapse if one thing goes wrong. Think about it this way. Your first commercial deal is where you learn how leases actually work, how the tenants actually behave, and how operating expenses actually show up. And don't forget that you're going to learn how the lender actually underwrites your deal. You want to learn those lessons on a manageable asset, not on a 4 million mixed-use building with 6 tenants and a deferred maintenance list. So as we go through these property types, I want you to be thinking about 4 things. How simple is it to understand? How hard is it to finance? How risky is the tenant situation? And how forgiving is it if something doesn't go to plan? Let's start with what I consider one of the most underrated entry points for first-time commercial investors: a small industrial and warehouse space. We are talking about properties in the 3,000 to 15,000 square foot range. Like contractor-based, flex warehouses, small distribution spaces. These are the unglamorous workhorses of commercial real estate, and that is exactly why they work so well for beginners. Here is why. First, the lease structures tend to be simpler. Many warehouse leases are triple net, meaning the tenant is responsible for the taxes, the insurance, and the maintenance. That shifts a lot of the operating complexity off your plate. Your job as the landlord becomes more straightforward. Second, tenants in industrial space tend to be sticky. A contractor who is set up their shop, their racking, their signage, they are not moving only they absolutely have to. Tenant turnover in a small industrial is generally lower than retail or office. Third, the business model is easy to explain to a lender. Square footage, rent per square foot, lease term, tenant history is clear and understandable, which matters when you are trying to get your first commercial loan. What is the risk? Well, if the space goes vacant, you have got a building that is generating zero income. And depending on your market, leasing up industrial space can take time. So you need to make sure you have the reserve to carry the mortgage through a vacancy period. And you need to understand the local demand before you buy. Who this fits? If you want simpler operations, a tenant who runs their own business out of your space and treats your property like their own, industrial is often a strong starting point. Self-storage is one of those asset classes that just makes sense. When you explain it out loud, you build or buy a facility with a bunch of individual units. People rented month to month to store their stuff, and you collect the rent. No long-term leases, no tenant build-outs, no one calling because the toilet broke. For a first-time investor, the business model is intuitive and transparent. Revenue is driven by occupancy and the rates you charge per unit. If one tenant leaves, you have lost $80 to $120 a month for that unit, not a $10,000 a month anchor tenant. That diversification of income across dozens or hundreds of units is a real risk buffer. Self-storage also tends to perform well across economy cycles. When the economy is strong, well, people are moving, they are buying things, and needed storage. When the economy softens, while people are downsizing, going through transitions, and still need storage, is one of those few asset classes that has a counter-cyclical argument built in. What is the risk? The barrier to entry has risen significantly. Good self-storage facilities in strong markets aren't cheap anymore, and oversupply in certain markets has put real pressure on occupancy and rents. You also need to think about management, either hiring a professional operator or using software to manage it yourself. It's not fully passive. Who this fits? If you want an asset where the income history is easy to understand, easy to explain to investors or lenders, and spread across many small leases rather than one or a big one, self-storage deserves a serious look. A lot of first-time commercial investors come from residential world. They have owned a home, maybe a rental house or two, and they want to scale up. For those investors, a small multifamily, think like 5 to 20 units, is often the most natural bridge. You understand the product. People need places to live. The lease is a residential lease. The tenant dynamic is familiar, and lenders understand multifamily extremely well, which generally makes financing more accessible than some other commercial asset classes. The income math is also straightforward to model. Multiple units means that if one or two tenants leave, you are not devastated. The remaining units are still covering most of your expenses, while you fill the vacancy. It is what makes a small multifamily particularly interesting as a first deal. There is often a real value add opportunity. Buy a slightly tighter property, upgrade the units, raise the rents to market rents, and you have forced appreciation through operational improvements. That is a skill that can translate to a larger deals over the time. What is the risk? Tenants are people, and people can be unpredictable. The maintenance calls, turnover costs, the occasional difficult eviction. Small multifamily is not a passive investment. It rewards hands-on management, at least in the early stages. And in some Texas markets, property taxes on residential investment property have climbed significantly and compressed your margins. Who this fits? If you are coming from residential real estate and want a familiar framework to build on, or if you want to have the option to add value through renovation and management improvements, a small multifamily is a proven on-ramp. Single-tenant net lease properties. Think a stand-alone fast food building, a national auto parts store, a miracle office occupied by one practice, and often marketed to investors as the ultimate passive investment. And there is real truth to that. When it works, it's about as close to mailbox money investment as commercial real estate gets. The appeal is obvious. One tenant, long lease. Often 10 to 15 years, and the tenant covers most expenses through triple net structure. You are essentially buying an income stream. The management burden is extremely low. For investors who want predictable passive income and are not interested in managing operations, this is genuinely attractive. But here is the trade-off that every first-time investor needs to hear clearly. When that one tenant leaves or when their business struggles, your income goes to zero. And depending on the building configuration, a single-tenant property built specifically for one use can be very difficult and expensive to re-tenant. A former fast food building is not easy to convert into something else. Beyond that, well-located credit tenants, triple net properties are priced to reflect their safety. Cap rates on the best ones can run 4.5% to 5.5%, which means you are paying a premium for that security. To generate meaningful cash flow, you often need significant capital or favorable financing. Who this fits? If your primary goal is passive income, you have a strong capital and you have done the homework on the tenant's financial strength and industry, single-tenant net lease can be a solid first deal, but going with your eyes open about what vacancy looks like, because the downside is concentrated. So how do you actually decide? Here is a simple framework I walk through with investors when they are figuring out their first deal. Start with your operating preference. Do you want to be largely hands-off, or are you comfortable being involved? If you want simplicity and low day-to-day management, lean toward industrial or a quality net lease property. If you are comfortable being involved and want to build skills, multifamily or a value-add warehouse might be a better fit. Then look at your budget and financing situation. Small multifamily and small industrial are generally more accessible to first-time commercial borrowers than a larger single-tenant net lease property or a self-storage facility with a significant infrastructure. Talk to a commercial lender early before you fall in love with a specific property. Then ask the honest question: what happens if the main tenant leaves? In multifamily or self-storage, you still have other tenants, so they're covering the revenue. In a single-tenant net lease, you are carrying the full mortgage on your own. What does that cash reserve requirement look like? Can you sustain that for 12 to 18 months if needed? And finally, do you actually understand how this property makes money? If you can explain that income model to someone in 2 minutes, how tenants pay, what expenses you are responsible for, how the property gets valued, you probably understand it well enough to own it. If you are still fussy on the mechanics, that's a signal to slow down and learn more before you commit. Let me do a quick side-by-side summary before we close. A small industrial. So it's high simplicity, accessible financing, relatively stable tenants, moderately forgiving, strong beginner option in the right market. Now we got self-storage. Which is intuitive model, income is spread across many small leases, but requires real management and market research on supply. A small multifamily has a familiar framework, strong financing access, value-add opportunity, but requires active management. Single-tenant net lease. Very passive when it works, but concentrated risk and higher capital requirements. Go in fully informed. So, no single winner. The right answer is the one that fits your situation. If you're trying to figure it out, which of these makes sense for where you are right now, your budget, market, experience level, that's exactly the kind of conversations my team and I have with investors all the time. Send us an email at info@thecommercialdeal.com and tell us a little about what you're looking for or what would you like to work with. We will get back to you and we help you think it through. No pressure, just a real conversation with someone who works in this market every day. And if you are not quite ready to reach out yet, that's fine too. Make sure you are subscribed, because the next videos are going to help you understand commercial real estate even more. Keep in mind, the best first commercial deal is not the flashiest one, it's the one you understand well enough to own it, to feel confident, to finance realistically, and manage it through the unexpected. Do that and your second deal gets a lot easier. Remember to like and subscribe. I'll see you in the next one. Ciao, ciao.